Hello, everyone. Today we're going to take a look at another measure of valuation, which is earnings yield. So earnings yield is simply the earnings per share of a given security divided by the price. So in this case, we're going to look at the S&P 500. So what you'll see on your screen here first in blue, the earnings yield for the S&P 500. You'll see a white line, which is the U.S. 10-year Treasury. Again, we're trying to measuring stocks versus bonds and valuations there. And then the shaded bars are recessions, just to give you some marking points along the way. So what we see in general is a decline of that blue line, more slowly, I would say. But the larger thing to notice is the real increase in interest rates over the last 5 years. So at a point to where they're kind of mashed together, or even bonds have a little bit of a higher yield than the earnings yield of the S&P. Maybe making this a little bit easier is flipping to the next slide, which is the net. So this is the net difference, earnings yield minus treasuries. So positive would have a positive earnings yield difference versus treasuries. Negative would mean yields are higher than the earnings yield. And so you see we've dropped below zero. This isn't the first time we've kind of bounced around in this area over the past year or two. But it does kind of take us all the way back to comparisons that we keep hearing, 99, 2000, 2001. And the question is generally, are we in that same kind of environment? Are we as overvalued as we were during that time? And also just the commonality of technology stocks being the leader just naturally draws you to that. So a couple of things. Yes, this is the lowest level on a net basis we've seen consistently since that period. But if you look back just a little bit further before 99 and that 2000 market correction, you see lower levels, considerably lower than we are today. So what this tells us is that we are beginning to see stretched valuations, but we're not quite as bad as maybe we were at that period of time. So maybe there's a little bit more room to run. And with interest rates coming down more than likely with what the Fed has planned, it is possible that we could see this earnings yield go up just a little bit simply from that math. Again, the net version be higher because yields are coming down. So obviously I have to see what happens with equity prices. That has a big impact on this as well. So not sounding alarm bells yet, but certainly an area that we're looking at and suggest you do as well. Thanks for stopping by.